So hello and welcome everyone to another session of C4S classes where we'll be taking MCQs related to finance. Okay. So first question on the screen is, as per India's vision for 2047, the countries aim to become a $30 trillion economy with a per capita income target of approximately how much? Okay. So there is a vision for 2047 document that was published by Niti Aayog. Okay. So there, Niti Aayog suggested or claimed that India could become a $30 trillion economy by 2047, but it would need a per capita target for of how much money? And the answer is 18,000. Okay, so this was in news again in September 15. That's why this becomes important. So the answer would be, for reaching a projected GDP of 30 trillion, we need to have a per capita income of at least 18,000. Okay. Now, next question is, which of the following statements best describes commercial papers in finance? So, first option is commercial papers are short term, unsecured promissory notes issued by corporations to meet short term funding needs. Next is commercial papers are long-term bonds issued by government to finance large infrastructure projects. Next is commercial papers are short-term government securities issued at a discount and backed by the central bank. Fourth is commercial papers are credit notes issued by central banks to control the money supply. Fifth is commercial papers are certificates of deposits issued by commercial banks for savings accounts. So the answer for this question is A. Okay. So again, an article was there regarding commercial papers. Okay, in news. So what are commercial papers? So these are unsecured short-term debt instruments issued by corporations to finance immediate expenses like inventory and accounts payable. So these are short-term in nature. Basically, their issuance maturity may range for maximum of 1 year and minimum of 7 days. Okay, so minimum maturity is 7 days, maximum maturity is till 1 year. Okay, so they are issued for meeting short-term expenses like cost of inventory or accounts payable. So these are these are zero coupon. That means they will be issued at discount. Okay, and at maturity you will get the whole face value of the commercial paper. Okay, and one more thing, they are issued in denominations of 5 lakhs and its multiple. Okay, that means 10 lakh, 15 lakh. So minimum denomination would be 5 lakhs. Okay, now moving on to next question. What is a follow-on public offering? So first option is a private company issuing shares to the public for the first time, a public company issuing additional shares to raise capital after an IPO, a company issuing bonds to raise long-term debt capital from investors, a private placement of shares offered only to institutional investors, a public company repurchasing its shares from existing shareholders. So the right option is B. Okay. So in one of earlier sessions, we discussed about IPO. So IPO is the first offering of shares to the public investors. But after IPO, if any more public shares are issued to the public or sold from the investors who are already there, promoters would be more appropriate here. So if promoters want to sell their shares to the public, then FPO route is taken. Okay, so where first time it will be going through IPO. After that, FPO is the offering which takes place after IPO, where new shares can be issued as well as shares owned by the promoters can also be sold in this offering. Okay. So as it was also in news that uh, India Incorporated raises record 30 billion in 6 months, riding FPO wave. Okay. So here it is written that it occurs when a publicly listed company issues additional shares to raise more capital after its IPO. So this allows a company to fund expansion or reduce debt. Okay. So basically we are issuing shares so that we are not taking a route of debt. That means company is not interested in taking loan, but company is interested in giving equity of the company to the shareholders. Okay. So unlike an IPO, which is the first public issuance of shares, FPO involves selling new or existing shares to public investors in a secondary offering. Okay. Now, before moving on to next question, it is just a reminder that UIIC AO exam is going to happen on 14th December, and we have launched a test series in that regard. Test schedule is given or is available on our Telegram website as well as on our Telegram as well as on our website. Okay, links are given below. So next question is, what are participatory notes in the context of financial markets? The first option is instruments issued by the Reserve Bank of India to regulate liquidity in the economy. Next is derivative instruments issued offshore by registered FIIs for Indian securities. Next, government bonds issued to encourage foreign investments in India. Next, corporate bonds issued by Indian companies for overseas investors. Next is short-term securities issued by the Indian government at a discount to face value. So the answer for this is B. Okay. So what are these P notes? So P notes are basically offshore derivative instruments. So what this means is, so these instruments are usually issued by FIIs. Okay. Big institutional investors issue these notes to investors who are not interested in investing in our Indian markets directly. Because if somebody invests in our Indian markets directly, then they have to comply with the KYC norms and other regulations that have been imposed by RBI as well as the SEBI. Okay. So to prevent themselves from coming under the regulator's lens, what they do is they take the P notes from the institutional investors. So if they are taking these P notes, so they are indirectly involved in the share market, or they have indirectly taken a stake in the shares that are floating in the Indian market without giving any KYC details to the Indian government. Okay. So here the definition is, so these are financial instruments issued by foreign institutional investors outside of India to invest in Indian securities without registering directly with the Indian market regulators. So they are typically used by foreign investors who want exposure to Indian markets with added anonymity and regulatory convenience. Okay, so it is a kind of an anonymous instrument because they are buying. See, let's suppose this X is a firm who is taking uh, P notes from this FII. So FII is invested in our Indian market, and Indian market regulated by our regulator like SEBI. Now, this FII, when it is investing in this Indian market, it has to follow the rules and regulations that are defined by the SEBI. Now, if this X is purchasing P notes from this FII, then this X company is not bound by the regulations that have been set up by the SEBI, because these regulations will be applicable on the FII, and this FII is making instrument which uh, which is a derivative instrument involving Indian market, and this derivative instrument is being sold in the form of P notes to the X. Okay. Now moving on to next question. Which of the following statements accurately describes the purpose of global depository receipt? So first option is a GDR allows a domestic company to issue shares in the local market to attract foreign direct investment. Next is a GDR enables a company to raise capital by issuing shares in multiple international markets simultaneously. Next is a GDR is a currency hedging instrument used to protect against foreign exchange risk. Fourth is a GDR allows a government to raise international funds for infrastructure projects. Next is a GDR is a type of savings certificate issued by banks to encourage foreign investment. So the answer for this question is B. Okay. So what is this global depository receipt? So this GDR, it is kind of a receipt that allows a company to raise funds from international investors by issuing shares in multiple foreign markets. So what is going on is, see, if a firm is interested in uh, in raising funds, so in raising funds from international markets, okay, so they can take two routes. First route is they can directly uh, list their shares in uh, stock exchanges of other countries. Okay. So if the firm is not interested in listing its shares on the stock exchanges, what it can do is it can go to a merchant banker or a bank of that institution. Let's suppose this shares, they need to take funding from US. So they will go to a US bank, and this US bank will take shares of this firm, and they will sell these shares in the form of depository receipts. Okay. That means if an individual in US purchases depository receipt from this bank, US bank, then they are indirectly taking a stake or share in the firm that is instituted or that is established in India. Okay. So this receipt that allows such investors from other countries to participate in uh, different countries' stock market, or that allows the their participation or their buying of shares of other markets without taking directly shares. Okay, so these are not direct shares; these are receipts that are issued by the US bank that are giving the guarantee that shares on these receipts are available with that bank. Okay, that's so these receipts are called depository receipts. So here it is saying that it allows a company to raise funds from international investors by issuing shares in multiple foreign markets. The shares are represented by GDRs, which are traded on stock exchanges. Okay, and these depository receipts that that the investor is getting, that the investor is purchasing from this bank, it is tradable on the stock exchange. So at any point of time, this can be sold by this investor to another investor. Okay. So what is this helping? It helps companies access a broader pool of capital outside their home country without the complexities of listing on each country's exchange. So as we said, they had two options. Either they can list their shares, and if they do not want the hassle of listing their shares on the stock exchange of other countries, then they might take this way of doing that. Okay. So that's all for today's session. Thank you and have a nice day.